Yeah, can I say both? So I think in this environment, both fixed and floating credits have attractive characteristics. They do different things in your portfolio. We tend to have a bias towards more floating at the moment, floating rate loans with high levels of current yield, shorter dated in nature, so they are less volatile. Structured credit as well, investment grade structured credit is an interesting space where we can get excess spread and excess yield over similarly rated corporate bonds in a floating rate format. So we really like that space as well for that high level of current income generation. So that allows you to keep duration down and have high levels of current yield. In the fixed rate market, what we like is heavily discounted corporate bonds that are shorter duration. So we're not going out to 10 years on things like that. We're keeping it in the shorter part of the curve, but they do have deeply discounted price in the 90s. So high yield bonds, single Bs, trading at 90 cents on the dollar. If you do your credit selection right and that credit doesn't default and goes to maturity, you have a pull to par. So it gets back to 100% of its face value and gets repaid there. So there's a lot of convexity there, a lot of opportunity. Less current yield, more a play on capital appreciation. Obviously, again, those markets are complementary. They do different things, I think, in people's portfolio. At Ares, we can play across both, across our platform. But for the Ares Global Credit Income Fund, what we were thinking about is that in Australia, when you look at the local market, you probably have a smaller market, so liquidity in the types of credit instruments that we trade in is not as much as what we can get in the US. Diversification is not as much as what we can get in the US and Europe. And therefore, we are trying to bring a $6 trillion global opportunity to the Australian market that allows investors to get the benefit of the Australian market environment, which tend to be more supportive of secured lenders, which tends to be in a country when you compare to other OECD countries that has good growth potential. But then doesn't have those other things, diversification, liquidity, and the breadth of the opportunity that you have in global markets. Yeah, when we look at our different markets, so you think about corporate loans, floating rate, corporate bonds that are fixed rate, and then alternative credit. I think at the moment we do really like the floating rate part that's higher yielding for the current yield. We also find very interesting pockets of relative value. So for example, if you look at alternative credit, we're going to favor investment grade alternative credit instruments that are floating rate over similarly rated corporate bonds, because on some of them you can get an extra 300 basis points of current yield. So that's pretty significant. If I take just one example in the market right now, you've got the collateralized loan obligations rated BBB. So they're not CDOs or like 2008 CDOs, the ones that blew up, very different instrument. They are trading right now because of a technicality, not a concern on fundamentals. They're trading right now at almost like 10% current yield. That's for a BBB credit risk. We find this incredibly attractive in our portfolios, and so we've been investing in that part of the market. Then when you look at the fixed rate part of the equation, so corporate bonds that are fixed rate, we really like those high yield single Bs that are trading at 90 cents on the dollar because of the convexity and the optionality that we have and the potential capital gains that can come from it. So when we look at our markets, I think we really focus on the US high yield corporate bond markets and European high yield corporate bond markets. And in the US, the average price is around 90 cents on the dollar. So if you select the right corporate bonds that they don't default, they go to maturity, or they get taken out earlier because they get refinanced or there is an acquisition, you get par back. You buy them at 90, you get par back. That's the natural pull to par basically for those bonds, and we feel in the portfolios we manage, they're a great addition to add that optionality and potential gain in price. On a current yield basis, they're not as attractive as the loans, so they do something different in your portfolio, but they are great to have as an accent in general in our multi-asset credit portfolios.